Hi, everyone, and welcome to our second mini podcast of our Udemy Mastermind. Only this time, instead of bringing you the audio, we're actually bringing you a little bit of a video. We're going to do a short little screen share here. Now, in case this is the first time that you're viewing one of this or hearing this, basically what Symon and I wanted to do is we wanted to get together and record these short conversations about different topics that come up in our Facebook group. Now, remember, we are not the definitive experts, or we're not giving you the one and only answer when we have these conversations, but instead, we just want to encourage people to chime in with their own thoughts as well and give you a perspective that we have based on our own experiences. Now, just to give you a quick background on myself, my name is Dan Rue. I'm a real estate and business consultant specializing in mobile home parks. We are actually just closing on a mobile home park in Missouri, and we just opened up due diligence on a 48-site mobile home park in Oklahoma. So it's been a very exciting and busy time for myself. Now, Symon, as you all know from his awesome Udemy courses, which I just have to say, as someone who's taken a course or two in my life, are extremely valuable. The amount of value that you get for what you pay, they are super awesome. So I encourage you to take a look at everything that Symon has to offer, because there's so much in there for you to learn from at a very, very extremely reasonable price. As you all know, in addition to being an instructor, Symon has also worked for a private equity group and helped analyze over $400 million in real estate deals over his career. So, Symon, welcome. How are you doing today?
Hey, welcome. Good morning, Dan.
Yeah, we're getting a little bit of a heat wave here in California. I know people probably hate hearing us living out here in California complaining about the weather, but
Yeah,
it's been pretty hot lately.
yeah. I think it's not so much the heat, but it's the sudden. It was like getting cool, and then it got hot again, and got cool, and got hot. It was just kind of like, just going back and forth there.
Very, very wacky. But now let's. Today, what we wanted to do is we actually wanted to talk a little bit about the case study here that Symon posted. But before we get into the actual nitty gritties of the case study and talk about the solution and all that, I thought Symon and I thought it'd be good to just start with the basic framework of the financial modeling process and kind of get into how you would approach a problem like that. So when it comes to analyzing deals like this, Symon, what's your first step? Like, how do you begin to approach these types of deals?
That's a very good question, Dan. And this is something that I get asked a lot from students who really want to take their analysis, their skill set in terms of being able to look at any real estate investment scenario and take it to the next level, where they're not relying on some sort of a black box analysis solution, right? And what are those black boxes?
Mm-hmm.
Black boxes could be an advisor, could be a friend who knows about real estate, or some of them think it's me, and they'll send me all their deal information. But ultimately, it's a black box because you send them all this information, and then hopefully they spit something back that you have a lot of confidence in and you trust, but then you don't really know exactly how they got to that recommendation, right? And the point of doing the modeling process and analysis yourself is, if you build it yourself, you know every single piece of that process. And so you can know exactly how one result was derived from your particular set of assumptions. Okay. Now, when you are looking at a situation, the first thing that I always do is to take inventory of what I have and what is missing. Now, for those of you that took a look at the first case study there, there were some people that are like, hey, what's the information on this? How come that's missing? Well, that's exactly the point, actually. You're not going to have everything handed to you by a broker, and they're going to say, hey, here's sometimes they would like to tell you should use this for your rent assumption.
Right. Yeah.
But you want to be able to say, all right, well, here are the things that I do know. What kind of questions? What is the main question I want to ask, right? And in this first case study, I kind of framed the question already. We want to know what is the impact of the CPI, if the CPI has different outcomes.
Right.
How would it impact the main lease in this particular case study? So for those of you who didn't look at it,
Symon, in case anyone had a question about CPI, what would be your quick explanation of what the CPI is?
The CPI, Consumer Price Index, is basically what economists would call a basket of goods. So things that like people typically buy, and this basket is generally like a handful of items that they track the pricing over time, and they see how it increases from one year to the next.
Right.
So all things equal, as CPI goes up, the value of your dollar, your purchasing power, goes down.
Right. So this is basically, you would say, it's just a metric for inflation.
Yes, exactly.
Okay, great.
So you take inventory of what you have and what you don't have. And what you don't have are the things that, what would I need in order to be able to answer this question? Now, once you kind of do that, the next step would be to start with the end in mind. What would you want to be able to answer at the very end? What would you want to be able to look at, right? So in this particular case study, we're talking about testing or understanding 3 specific scenarios. If CPI is low, if it's in the middle, or if it's really high.
Right.
So when you want to answer questions like that, the end result is something where you want to be able to look at 3 different scenarios there.
Okay, yeah. 3 different scenarios and see what the internal rate of returns are, the yields, and the cash multiples based on a range of different things that might happen with inflation and so on and so forth. I think that's a really good point, because with the deals that I've been analyzing and helping to make recommendations on, the first thing that one of the principals will come back to me when I sort of show them what I've done is say, well, what happens if this happens? And what happens if this happens? It's like, it's never, it's always a fluid thing where it's not so much about, well, this is what's going to happen. It's more like, well, what are the range of possibilities that could happen, and where do you think the deal falls within this range of possibilities? So I think it's definitely, when it comes to modeling, it's very rare that you just churn in one exact model. It's more like, here's the high and here's the low, and here's where I think we're going to land and why.
Yeah, and a good analogy is like it's thinking about how tall is that room going to be, from the floor to ceiling.
Right.
You can't submit a board that's like an inch thick, right?
Yeah.
Nothing's going to fit in there. So you're really doing analysis to put a boundary around what is the likely outcomes, and getting comfortable with both what the ceiling is and what the floor is, and where you expect your baseline to be.
And a lot of this just has to do with the investors too. I mean, not only do you do it to I think make sure that you're aware of how things can go, and you can later on we'll probably talk about stress testing and things like that, but also just to establish trust with your investor, because that's one of our primary, if not the primary, important things that we need to make sure is keeping that trust with the investor. And if you show them one thing, unfortunately, they get fixated on one number. And if you don't come in at that number, then, there might be a deterioration of trust, and they might not, they might not feel so great about it. But when you come in with a range of possibilities and kind of say, well, here's where we think it's going to, here's potentially what might happen, and here's the high end and low end, then I think you're able to more to deal with that type of situation a lot better.
Yeah, absolutely. I think it's about setting the right kind of expectations, right?
Yes.
You pick one number, you're setting the expectation. This is what it's going to be.
Exactly.
But if you provide a range, in addition to setting more realistic expectations, because no one's that good. If you're that good, you're going to have a lot of investors that want to throw money at you.
Right.
But the other thing is, by providing a range, you can only provide a range if you're actually thinking about the different potential outcomes. So it shows that you're doing a broader set of thinking. You're taking more things into account, and that your analysis is more robust in that way.
Yeah, that's a great point. It shows that you've thought it through. And thought about not just the best case scenario, as most pro formas you see are always about the best case scenario, but also that you thought about the floor as well.
Yeah. So once I have a good idea, and a lot of times when I start a model, I'll actually just put a dummy version of what the result should look like. So then I'll put the headers and labels, and I'll put some fake numbers in there as placeholders to see. I want to see something that looks like this. And then everything else I would build to drive towards that.
Okay, so you almost you make the deliverable, the end result first, but you just have everything blank.
Yeah, everything else blank, and then everything else I do will build towards that.
Okay,
right?
Okay, that's great.
So after you have that, then I start back at the top, and the first thing at the top you want to do is to determine your timing constraints. Are you looking at this? Do you need to look at it on a month-to-month basis, or is looking at a yearly sufficient? And how long are you looking at it? Right? What is the full timeline, a term of the project?
Right.
So once you determine those factors, the unit of time that you're looking at and the length, then it kind of bounds everything else. Everything else, all of their assumptions, all other events related to this particular scenario investment that you're looking at has to happen within that time range, and has to happen in any one of those increments of time.
Okay.
So this kind of sets everything in the right place.
Okay. So you're going to decide whether you want to look at this on an annual basis, on a monthly basis, if you want to look at it on a daily basis, whatever fits the sort of the scope of the project that you're looking at.
Yeah. So generally, the more early on, if you're doing kind of back of the envelope, you want something what's called like a quick and dirty analysis, where you just want to get a ballpark. Yeah. Sometimes you're just looking at the annual ones and you're making some broader assumptions. You just want to see if it's kind of in the ballpark.
Right.
And that's where that may make sense. But where you two want to do some more accurate analysis, and let's say you got leases that are renewing at random months throughout the year and they're all at different places, then you better be doing it by the month to accurately capture the cash flows.
Right. Yeah, that makes a lot of sense. And actually that brings up a good question. We don't have to answer it on this thing, but I think at some point we should talk about the difference in IRRs when you're looking at it from an annual basis versus a monthly basis, because I know the formula changes a bit.
Yeah, there's a couple ways to address that, and we'll get into that when we get there.
Yeah, we'll figure that out later. Yeah.
Cool. So once you have the timing, the next thing to think about is all of the big assumptions. All right, this is before you actually do the cash flows. A good way to think about it is, what are the things that could affect the cash flows, right? Or affect your so cash flows, both cash flows in and cash flows out. Okay, so things that would affect your expenses, things that would affect your rents. Just off the top of our heads, things that would affect your rents. Well, your starting rents, or your CPI, or your inflation rate, or your rent bumps.
Yep.
Right. Any kind of changes to the rent terms in those ways. So those the assumptions there. Anything that's related to bumps to your expenses that would affect your ultimate net cash flow. So think about what are those big assumptions. You want to put all those up there. So big assumptions could involve timing too. Yeah. Like, I don't think, I have a lot of units, but I think after construction, it's going to take each unit 3 months before I can lease it up.
Right.
Okay. And then if let's say someone is building, a group of homes, but then they're building them kind of in succession and not all at the same time because they don't have all the funding. Yeah. They need to sell some to fund the next one or something like that.
Then like you're building a model track.
Yeah. Then you can't just start modeling the numbers of the cash flows coming in and out. You need to set aside some things to adjust the timing, because what you don't want to do when you're modeling is combining two factors into one line. You want to separate them and make it as modular as possible. The reason for that is if you combine like timing and cash flow assumptions all in one, what happens when you need to change assumptions for one, then you end up having to adjust kind of the whole thing there.
Right.
By kind of separating them, you can adjust them very very easily.
Okay, so you have like the way you have it set up is each assumption you can almost think of it as a different grouping of informations. So you can have like a grouping that deals with one assumption and then another assumption and then another assumption, as opposed to having it all mixed up into one formula, so to speak.
Exactly, and it because one of the and I'm going to go this process, but I'm going to go through some of the best practices. Is
Right.
Some of the best practices, you never hard code your assumptions, right?
Okay,
One of them
right.
is if you're assuming like for example, if you're assuming a 5% rent bump every 5 years, you don't go into the cells where the actual rent is calculated and say times 1.05.
Right.
You want to leave that 5% out somewhere,
Right.
so that you can see it. And
Yeah,
if
yeah.
you do change it, you can just change that one cell and it changes everywhere else, right?
Yes.
So we'll go into some of those things today. I just kind of go over the broad framework,
Right.
but there are a lot of best practices, including little things that you want to do on your spreadsheets that just makes everything, one, more professional, two, easier for you to manage, and ultimately makes your model more accurate and more robust.
Yeah, I've been using a spreadsheet, and I started to do that where I didn't want to go and create reference cells, so I just started messing around with the formulas and then leaving notes for myself, and it just got really really messy. And it kind of reminds me of, it's like that when you're coding. I don't know if anyone in here has ever done any coding, but there's a certain type of way that you code and that like best practices and labeling things a certain way so that anyone can come in and take a look at your code and understand it right away. And it's almost like a science experiment where whatever you've created has to be replicable by other people. Otherwise, you haven't really created a valid theory or hypothesis.
Yeah, because even if you're your own audience, if you look back at some models 3 months later,
yes,
and you don't have, it's not very easy. You're gonna be like, wait, why? How did it do this? What?
Yeah.
Because then all your assumptions are hidden. So anytime there's an assumption, anything that can adjust or change the outcome of your analysis, it needs to be out in the open. It needs to be right there, clearly labeled, and something where it has its own cell.
Right.
To reside there.
And I always think I'm going to remember it. And then after 10 deals later, I never do. So it's really good practice to keep notes and like you say, set it up a certain way where all your assumptions are very, very visible and plain to see. Which I'm excited about that too, because I just created another spreadsheet, and I want to hear what you have to say about best practices later on.
Cool. Yeah, we're definitely going to do that. So after you have the best, your big assumptions, handled there, then the next thing we're going to get into will be the cash flows.
Okay.
But cash flows in. So we're talking about all the sources of revenue. Now, for most real estate, it's going to be rent. But there's certain types of real estate that will be either operating, or they may have other sources of revenue. So you may want to segment your rent. So maybe if you have mixed use, you may have rent by the different asset types that you have, and then within the asset type, you may even separate them by the different major tenants or groups of tenants, or if for the residential part, you may separate them by the floor plans,
right?
And the number of units. So it changes in terms of how you segment the different sources of cash flow in, but it should be relevant to that particular project you're looking at.
Right. Okay. So depending on what type of, whether it's a new construction or you're taking over an existing apartment that's very stable, or however it is, you might want to change that, and maybe if it's commercial, you might look at square footage and different ideas like that.
Yeah.
Okay. Great.
And then the next one, obviously, we're going to start looking at cash flows out. So we're going to look at your expenses, your maintenance, and other things that are going to net out from your gross rents, right? So you can get to net rents. That's however you set up your cash flows in, when you set, it makes cash flows out very obvious.
Right. I think that's one thing. This goes back to the big assumptions. I think the biggest thing that I come across are asking people about their expenses, because we're purchasing existing mobile home parks, and usually their assumptions on expenses are not the same as what we think coming in, and either they're trying to fudge things or they're trying to hide things, or in a lot of cases, people have, they do things like they self-manage, so they don't charge themselves a fee for that. So then, we're doing this stuff remotely. We're going to manage ourselves. These are different assumptions, the cash flows out that we have to really, really be careful about, make sure that we've adjusted for.
Exactly. A lot of times, you have these owner operators that, they're not paying themselves a salary, right? They're pulling directly from the profits, right? And then if you're buying it, but you're not managing it yourself, then you do have an extra expense there.
Or they're really handy with the tools, so they'll just go in and fix things, and then they won't expense themselves. So
absolutely. Mm-hmm. Cool. So then once we have that, I like to then keep any kind of cash flows in and out that's related to purchases and exits separate.
Okay.
So the reason I don't want to combine it into kind of more income driven cash flows is it's cleaner. Yeah. It's a lot cleaner, and you may have different assumptions about your purchase. You may, you may change the actual purchase price. You may negotiate it down, or, there may be some other things going on there where you don't pay all of it up front, and you have a certain amount in escrow that has a certain probability of being used or not used because of some condition, on the property that you discovered, right?
Right.
So you want to separate it so that you can see it clearly. And then the same thing for the exit, because obviously your timing when you sell or exit. Now, if you're looking at a single property, it's going to be like it's the timing. It's going to happen at one time, but you're going to have some assumptions around what you're exiting at.
Right.
But if you're selling now, the only time where it might be a little bit different in terms of modeling the exits is if in the example I kind of mentioned earlier about where you have multiple assets that you're selling kind of throughout the life of the project. You're not kind of selling one, like you have one big sale and it's sells your entire asset, but you're selling little pieces.
Okay,
that's where it's going to look a little bit different. But we're not going to do that yet. We'll explore that scenario in a specific case study later on.
Okay, good.
Now, then obviously once you have all those, you can combine the cash flow. You can have a combined cash flow line, and that's where once you combine it, you can really see what you got to put in initially, and how much and how much the cash flow start coming in, and what do you get at the end of the term, and you get to see all that. And when you have those combined cash flows, that's when you can actually start looking at the next step.
Right.
The next step. So when you combine them here, actually, I want to just say this is before we look at any financing. This is just basically assuming you're doing it on an all cash basis, and you want to make sure you're completely comfortable with your analysis in an all cash basis before you look at anything around financing.
Okay.
So once you have all the all cash stuff handled, then I start doing the modeling around the financing and the assumptions around there.
Okay.
And, that's where you look at, sometimes you may look at both, more than one scenarios in financing. You might look at an interest-only type of loan, or you might look at, something that is more traditional, that's on a longer term, fully amortized. Or it may be something where you have some short-term financing for construction, and then there's a refinance, right? So you want to separate this whole section by itself because, well, you don't know, it may change, and you don't want it lumped in with everything else. If you change any financing assumptions, again, you only want to deal with that one section.
Okay, so you want it all set up with the all cash assumptions unlevered, and then later on you can add in different financing assumptions, because again, financing is another one of those things that can dramatically change the deal. If you end up extending the term, for example, on your repayment, then now all of a sudden your debt service goes down, and that changes your cash on cash. That changes a lot of different numbers as well. So just negotiating financing terms could end up making the deal a lot better or a lot worse than some of these other things that you can do as well.
Yeah, and there may be deals where when you look at it on an all cash basis, it's not workable. It's not there. But maybe your group or you have access to some really, really attractive financing that then makes it work.
Yes.
Right? Then you can use financing this part to say, all right, well, here are the minimum financing terms that would make this deal work.
Right. Yeah, I've definitely noticed that. Like once you start throwing conventional financing on some of these deals, and it radically changes the outcome and the look of things. And so definitely financing is an important part of this whole process.
Yep. And then after this, then what I would do is model out the capital structuring part, and this is the capital portion that is outside of financing, which is if you have other investors, you got other players coming into the equity portion of it. And this is where the waterfall framework and carry interest and all of that good stuff will come in. So for individual investors where they're putting in all of the equity and then they're finding their own financing, they won't need to do this.
Right.
But if you're putting a deal together and you got some partners that are coming in that are just providing capital and you're doing all the work and you want some extra incentives, this is where you would model out your proposal,
right?
And tweak it and change it to see how it affects each player, right?
Yes.
So that's where this would go in. We would do this pretty much close to the end.
Right. And then also the equity split and whether you have preferred interest and all that stuff. Will definitely change the returns and the type of investor that you might be able to attract, depending on what you can do. And as your waterfall framework points out, there for yourself, in order to make the deal better for yourself, if there's a lot of meat on the bone, I mean, just by adding in different waterfall frameworks, you can end up not only returning a great return to your investor, but also helping yourself a lot as well for being able to exceed expectations and being able to really deliver a great deal. You
And then the last part, once you have all this, is you look at the results and you do more testing. Okay. And you'll once you have the model built out, you're going to have a certain set of results. And then what you want to do is you want to start testing the boundaries of the most important assumptions.
Okay.
And that's where you may do things like a sensitivity analysis, and we can look at some of that later as well. So that's it. This is the framework, the process. I think a lot of times, especially for folks that aren't familiar, that haven't done this, they may be like, well, where do I start? What do I do next? Right. But once you kind of walk through this process, you're like, well, okay, this makes logical sense.
Yeah.
The framework is really not that difficult. It's once you understand the framework, then it's just getting practice on actually executing it.
Right.
Because when you start executing, you start having to learn a lot of things about Excel. You start need to learn things about Boolean logic.
Yes.
Because a big part of modeling, most of the modeling actually doesn't have anything to do with the real estate itself. You need to know how to do things that are just outside of real estate.
Right. And just setting up the logic of your spreadsheet the right way.
Exactly.
And how you line numbers up. So later on, when you're trying to get the internal rate of return, it's a lot easier than having to randomly pick cells out and say, okay, these are the different cash flows here. On all these different things. And the great thing about the framework here is once you have the framework in place, once you have it down, I mean, you can use it from anything from a single family house down the street that you're looking to rent out or an Airbnb or whatever to, a multi-million-dollar commercial investment. It's the same framework, wouldn't you say?
Yeah, absolutely. And the other thing is you don't have to go through this entire process of actually executing in the spreadsheets every single time, especially if you're looking at the same type of deals, right? You really go through this process deeply and build a model that you're very comfortable with, that you are very confident about using for a certain type of deals. Right. Then anytime you have the same type of deal but a just different asset, you're just punching in different numbers now. You're basically you're getting a lot of reuse out of it.
Yes.
Right. this whole process, you have to go through each time if you're looking at something new, and you know that's different and a totally different market, different asset type that has a weird structure. There's something different and weird and unique going on. Then you want to start from scratch. Yeah.
Right. Yeah, that's one thing I've noticed too. Is and I mentioned that earlier. There is a spreadsheet that I use, but in a lot of times, like for one example. One of the scenarios was we were actually going to get a discount on the debt service. We were going to get a discount on that debt service for the first 5 months, and then after that, it would revert to whatever the normal amortization schedule and all that stuff was, and the investment model wasn't set up for that. So now you got to come in and you got to figure out, well, how do I model out the amortization schedule, and how do I figure out how do I manipulate the spreadsheet to deal with that one particular scenario?
Yeah. So yeah, this is the framework, and then next time we're going to go through in detail the solution applying this framework. The solution to that first case study that was introduced.
Okay, so this is it. For today, this is the framework. If you haven't looked at the case study, you should definitely go and check it out. I actually worked through the case study myself, and as you're going through it, you might come up with some things like what Symon said earlier. Are there any assumptions that are missing? Is there more information that you might need? And go ahead and just post that in the Facebook group, and we'll go ahead and start a conversation on that. And then maybe next week or in 2 weeks, we'll go ahead. We'll have another one of these video podcasts, and we'll go ahead and Symon will walk you through how he would approach this problem and how he actually solves it. Does that sound right?
Yep, that sounds good.
All right, guys. Well, until next time, then. Thank you very much for tuning in.
Bye.
Bye-bye.